All right, guys, the future is officially here. Courtney and I just went to lunch and literally had our first automated salads. It was all robots. It really was all robots putting the salad down. There's only a couple of people actually working there, putting the final touches on the salads. But that makes me think, man, oh man, this AI automation thing, maybe it's not just a fad.
Hope you didn't get any nuts and bolts in that salad.
No, it was amazing, Bob. I mean, you go and they have all of the lettuce in these tubes and they start spinning them to make your individual salad. It goes down this ramp into the couple employees they have there. But there's usually a line out the door there, and they have so many employees who are trying to crank these out. But suddenly they need few workers, and there was no line because people are getting in and out of there so fast. And I think it's just an example of how this artificial intelligence or automation can actually really improve productivity, which I think is going to be the future. And it was interesting to see that firsthand today.
I mean, that's really amazing. But, for my money, nothing gets better than a steak on the grill by Bob. I don't think AI can replace Bob. Bob Propane, as we like to call him.
I don't have my secret sauce, Chris.
That's right.
But, I tell you, that's a good point, though, guys. I think that's what the market just woke up to, is that AI is not about a couple semiconductor stocks or a GPU manufacturer or even a software company. It's going to benefit everybody, right? It's going to be increased productivity, which means improved margins. Improved margins means bigger earnings. Last I checked, stocks are still the slaves to earnings powers.
Well, I just wonder how many company conference calls this quarter are they going to mention AI, no matter what your company is. Hey, I think we should change our name to paincapital.ai because we use ChatGPT once in a while to help with our copy. So the valuation of our company just doubled. Awesome, guys. I'm retiring. It's been a lot of fun.
Well, I think the biggest problem with these AI stocks is it kind of reminds me when we were kids. We go and jump on the trampoline. You get more people jumping on the trampoline. Eventually, people are going to fall off and get hurt.
What are you saying, Chris? That investing is a contact sport?
Chris, that may very well be, but let's face it. I mean, we saw tech stocks maybe sold off a little bit, but I think the big difference was we saw big rotation into a lot of these dormant, let's call them sectors or asset classes, right? We saw real estate, small cap stocks, financials, all moved big last week in a matter of days. And it's all predicated on the fact that the Fed may actually cut interest rates come September, which just reminds you, things change and they change on a dime.
Yeah, and it's just a reminder of why you need to be buying those unloved stocks while they're still unloved. Because when things change, they change on a dime. You saw that last week after we've been hammering on the table to buy those things that are not the artificial intelligence exciting stocks right now. But when they change quick, and you need to make sure you're invested before that happens. And that's why being diversified is so important.
Yeah, we're kind of like an animal shelter here at Payne Capital. We take all the unloved pets, and they end up being the best pets, the most adorable.
Just a long time to wait because we've waited a long time for some of these things to move. But they do move. And again, it happens when it's least expected. And, a lot of people forget, but back in 2022, NASDAQ stocks were down 30%. Meanwhile, value stocks barely went down for the year. So, you want to protect yourself. You want to diversify because you don't know when those changes are going to happen. Nobody has a crystal ball.
Well, you would think the economists do, but they've been talking about a hard landing, soft landing. But here's the thing. Here's the dirty little secret. The economy never landed, right? It's been churning along now and chugging along for the last 3 years. Meanwhile, everybody's trying to time the market or time the economy, which is impossible, which makes investing so hard.
Well, investing is a lot like skydiving. And I know none of us have skydived, I think, except for Courtney. But I think the idea, Courtney, correct me if I'm wrong, is that you always want to have that parachute on before you jump out of the plane.
Sounds like a good idea. Yeah, I would agree with that.
Otherwise, you end up with what I had for breakfast this morning, Chris, pancakes.
But no, it's a good point. And I think, what you want to think about right now, too, is, again, there's still a lot of money sitting in cash on the sidelines. And this AI trade that we talk about a lot may still go up, but there's a lot of other places to put your money that haven't moved as much, have a lot of potential to move. And when they do move, it happens very, very quickly. So again, it's just like, the old Wayne Gretzky quote, you want to kind of skate where the puck's going to be, not where it is right now.
Well, what's happening right now is that, the trends that we've been talking about ad nauseum for a couple of years have continued, right? We had moderating inflation. We had economy that was continuing to grow. We had earnings that were setting record quarters, earnings estimates that were setting records. But what it took was the perception, right? It's not about the facts. It's about the perception of those facts. And finally, the market woke up to, oh, wow, we're now at 3% annualized rate of inflation, not 3.3. Fed now is comfortable cutting rates at 2.8% inflation. Prices haven't come down, right? They're just going up less. fast. And then the market just woke up to it and said, hey, there's a lot of opportunity here. And then you just don't know when those turning points are going to be. That's why you've got to be an investor, not a trader.
Well, it's like that saying that people say, oh, the trend is my friend. But when you end up realizing it, that the trend has no friends and certainly not yours.
We talk a lot about this artificial intelligence trade, but Ryan, you brought up something interesting here where energy has actually been outperforming the semiconductors, which is that AI trade, on a 3-year basis. And looking forward, that's something that still has a lot of opportunity. And I don't think what people realize kind of is the second tier AI trade. It takes a lot of energy for this artificial intelligence and those data centers, not to mention things like electric vehicles, et cetera. But a way to play that in the longer term is something like an energy.
Well, I think that's the point, right? And we've said this a lot, is every company is going to be an AI company. Like that salad company today, Kurt, I think you were telling me that they're getting so good with their algorithm, they know which salads sell the best at certain parts of the day. So they know how much exact salad to have at that part of the day for that specific salad. So, I mean, there's just so many applications. And that's really what it's about over time. It's right, productivity gains. It's the fact that companies continually over time increase their margins, they come up with more efficient ways to do things. And that's not just germane to mega cap tech stocks and artificial intelligence stocks that create the technology. It's about every boring a salad company. What's less exciting than a salad company? And here they are automating everything right in front of us.
Guys, you're missing the whole point. It's all about the election, right? The market's made all-time record highs this year while Biden's president. The market is now making all-time record highs because Trump's going to be president. Don't you read the newspaper? I mean, every headline I read on Monday was, here are the 3 stocks to buy now that Trump's going to be president. Here's the Trump trades that you now have to put on. The president has nothing to do with the market. I mean, I've been doing this for 50 years, and it turns out it doesn't matter who sits in the White House as long as there's someone sitting there.
Don't worry, Chris didn't even know there's an election this year, so it's not a big deal.
I love election years. They're always positive for the market.
You must be talking to yourself again, brother.
Well, I think that actually does take a little bit more risk out, because we know what a Biden presidency looks like. Whether he's cognitively there or not, that's another debate. And we know what a Trump presidency looks like. We've already had it. So I think it's actually less of a surprise factor to the election this year. So one would argue have even more certainty than you normally do an election year, which again, that's probably a more bullish sign than even normal. And given the fact that you usually have a good election year.
Yeah, I've been hearing more and more about the Trump trade and the idea that some of these more underloved sectors might have less regulation, which is actually a good thing for those. But I think kind of irrespective of what happens in the election, those stocks look good anyway. We're talking about this rotation that's happening and why you want to be in those. I would be there regardless of the election. These things look like good opportunities with rates coming down.
Well, I think the rates are really the key, because it's interest rates are a tax on everybody globally. So as rates come down, you have to adjust your prices up, right? The markets are always about price adjustments. It's an auction. It's what somebody's willing to buy. And when you're buying something, there's always a seller on the other end of the trade. So you have to recognize that 2 big things are energy and interest rates. Interest rates are coming down. And if Trump becomes president, drill, baby, drill, I would say price of oil may be coming down as well.
Hey, hope you're enjoying episode 153, Pain Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you saved over $1 million for your financial independence plan and you want a more hands-on approach, Bob, Chris, and I now have a collective 75 years helping individuals just like you with your planning and investing. This is what we do every single day. We'll put together for you a total financial master plan. We'll do a bird's eye view of your entire financial life and hone in on every financial issue you need to address today. There's not a firm out there that will do this work up front. In fact, we'll build you your own personalized financial portal. We'll go through and look at everything you need, from an income plan for retirement. How do you draw from your portfolio? How do you take Social Security? We'll do a full deep dive of your total portfolio, look at your diversification. Have you had way too much money in the market? Have you seen your portfolio go up and down like a yo-yo? Or have you been sitting in cash, paralysis by analysis, can't figure out what to do? We'll put together a full investment game plan. We'll show you how to grow your wealth, tied to your goals, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, insurance product, structured product, brokerage product. We'll do a deep dive of all those investments, show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook. If you saved over $1 million for your financial independence plan, Simply go to www.paincm.com/financial plan or click on the link below to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. Of course, that's PAYNA, having the biggest impact on your wealth right now. And, wild times like this in the stock market bring out wild emotions, guys. I had this woman, she wanted us to do a review for her. Of course, she had all her money in the hottest tech stocks. And she told me, we don't want a boring S&P 500 return. I want somebody who can do better than that return. Now, the caveat is this woman is set for life. She's got a couple $1,000,000. If she gets a conservative return, she's set, yet she wants to keep leveraging her portfolio. And in my mind, man, oh man, if the market goes against her, not only is she not going to be able to retire anymore, she'll probably have to go back to work. But it's kind of crazy, this different mindsets that you see right now.
Remember Ryan used to say every week, greed is good. What happened?
Wall Street is my favorite movie, Bob. And, Gordon Gekko, one of the greatest characters of all time. But greed usually doesn't end very well when it comes to investing.
Well, and it's funny, right? You tell that story like that's an outrageous story, but that's not uncommon. I mean, I have so many of my clients that, when we go through performance, they're like, oh, well, we should be making more money. The S&P did this. And I show them the same thing. I show their projections that they'll be set for life. And a lot of times I'll show them spending more money than they actually spend today. And it's always more, more, more. And it's just because their friends are making more, more, more.
Yeah, and we actually, Bob and I were talking to somebody recently who was in this scenario where they just retired. They have done a very good job of saving. I mean, they can very comfortably live their life and go and sail on the water and spend time with their grandkids. But we ran a scenario on their projection that showed another 2008 bear scenario happened right around the time they retire. Suddenly, they're actually in jeopardy of running out of assets throughout their lifetime. Whereas they get a conservative 5% rate of return, they're set. And that's something you just always want to look at is, can I sustain a big downturn? Because that's really what you're facing if you're overly aggressive.
Hey, you guys, I don't know if you've seen the announcement, but CNBC just announced that Courtney's doing a new series called Scared Straight. She takes her wealth projections and she takes these aggressive investors and she scares them into becoming a straight-laced investor and being set for life. Way to go, Court.
I'd watch that show. I'd watch that show in a heartbeat. And I think, I think the wrong message is, I think there's this idea of make hay when the sun's shining. And it's not right, because when things are going up and everyone is getting excited about the market, and in fact, I think we're at an all-time high in equity allocations or stock allocations, people's 401ks, this is not the time to get more aggressive. This means you probably have more risk. Ironically, you want to make hay at the darkest hour when it comes to investing. It's when everyone hates the market and prices are selling off. That's the biggest risk I see today. Is it's not about getting all the upside in a bull market. It's protecting yourself in a down market. We talk about that a lot.
You know, Raj, because none of these people have ever heard the Bobism. We make all our money in bear markets. And that's the truth of the matter is when you're in a bear market, when prices are on sale, when you're compounding your money at the highest level, you just don't know it. And that's the hardest part about investing.
Yeah, that's right. And going back to Ryan's analogy about making hay in the summertime, you don't plant seeds in the middle of summer. You plant seeds when it's springtime, before the sun comes. And, I did a 401k presentation recently and I showed the participants, what happens when the market pulls back. And I showed them they had to work an additional 5 to 10 years. And that scared the group pretty good, going back to Courtney's analogy.
I didn't know investing was like farming, but now I feel like I'm a man that goes out on the land and
there are other companies where people don't like the guy they work for.
Now, working for Bob's not that bad, guys.
Hey, whoa. Well, it just goes to show you how hard investing is, right? It's been a big roller coaster. And it's only 2 years ago that this big booming bull market made a bottom. A lot of people don't remember that, right? We have short-term memories. It's almost, I wish the industry would eliminate monthly statements because I think it's counterintuitive to investing properly.
Or like Madoff, he just made his own statements up. Well, that's bad joke.
I don't recommend that.
Yeah, but no, I think the other thing to consider, I think about this woman who was saying, I want better than S&P 500 returns. And I think what most investors don't realize, well, the S&P 500 has some bad years. In fact, collectively, it was down close to 60% during the great financial crisis. Collectively, it was down over 50% during the dot-com bubble bursting. These weren't that long ago. So I think what you have to look at, and Bob, I remember your back of the napkin math when you would show an investor, here's your $4 million. Well, guess what? Based on how you're invested, going to a bear market, it's worth $2 million. You have to be realistic. If you just own the S&P 500, there's a good chance you could see your portfolio get cut in half at some point. And you got to ask yourself, am I okay to deal with that? Can I see my 4 million go to 2 million, my 10 million go to 5 million? And most of us probably aren't.
And I would argue, Ryan, probably right now there's more of a risk of that because the S&P 500 is more concentrated than it has been since basically the dot-com bubble, where you have the top 10 companies of the S&P 500 constitute over 40% of the index. So it's not 500 companies you're owning collectively. It's a big portion of just a handful, and that just makes your downside risk higher.
You know what I love, Courtney? We haven't had this much of an overvaluation relative to small value since 1999. And I don't know what you, but I remember what happened after that.
Well, going back to this whole concept, what is enough? I mean, most of us can get away with the boring 5% rate of return on our money with 40% of our returns just coming from boring interest and dividends and be set for life. Why you'd want to take more risks than that? Why you would want to go out and buy individual stocks? Like, to me, that seems completely insane.
Chris, I do love that concept of enough, but when I put out my new book, chapter's going to be more than enough. And I can't tell you over the last 50 years how many clients and investors that I've met who had more than enough, but they were overcome by greed. They were overcome by scarcity, jealousy of their neighbor or their cousin or their brother who was making more because they were being more aggressive. So in the case of achieving your financial goals, greed isn't good. Patience is a virtue.
All right, the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, immigration. Foreign workers now account for 19.2% of the labor force. That's more than I thought, up from around 17% before the pandemic. The foreign-born labor force has risen by 1.5 million since June of last year, but I suspect those numbers are probably a little understated given what's going on the southern border.
Rod, that's an incredible statistic. It just blows my mind that we're at 4.1 unemployment, which is almost a record low. If we didn't have immigrants taking these jobs, what would the unemployment rate look like?
Yeah, fair point. That is one of the unsaid factors in keeping the unemployment level low. All right, Courtney, the average share of 401k plans in stocks has reached 72%, its highest level since January of 2001 when the dot-com bubble was bursting, according to an All Light Solutions 401k index. We can imagine where most of that money is allocated to. NVIDIA.
And this can be good news and bad news. The good news is that means all of these investors are benefiting from how well the stock markets are doing right now. Especially as a younger investor, you want to take advantage of that. You're adding into the 401k, you want it to keep growing. The downside is the more aggressive you are, the more of a downside you can see. And to your point, Ryan, we do see a lot of people just in S&P 500 funds, which is a lot of money in NVIDIA. Your downside risk is higher. Take a look at your 401k and make sure you're not doing so.
Be fearful when others are greedy is what comes to mind. Another great show. Court, thanks for joining today. If you like our podcast, love our podcast, please give us that 5-star rating on Apple, or if this is on Spotify, you can also subscribe to our channel. If you're watching this on YouTube right now, you can like this episode. You can also subscribe to our channel. Click that notification bell to be updated every week of all our new content. Your support gives us the support to continue to do this podcast. That's it for this week. Stay loose and keep an open mind.
Thanks for listening to The Pain Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.